So good evening, ladies and gentlemen. We will be starting in few seconds from now. Also, it is customary for us to announce that we'll be recording this session for training and quality improvement process. Welcome to all of you. Thanks for joining us for this exclusive session with Amit. Let me begin by introducing the eminent panel of panelists for today's session. We have Sanjeev Arora with us. Sanjeev is a chartered accountant and has been with us for a very long time. He takes care of our East business. He's zonal head for East business. Sanjeev, you can just raise your hand so people can see you, so that while questions can come to you towards the end of the session. Thanks, Sanjeev. We
Thank you,
also
Manish.
have with us Kishore Rizwani. Kishore is head of our South. Kishore is rank holder's chartered accountant and has been with us for over a decade, and he has total experience of over 2 decades. He's a known name in South industry and one of the very intelligent guys. So we can also ask him anything towards the end of the session. We also have Bharat Parikh. Now, Bharat, I'll just introduce in slightly more detail. He's host for us. So Bharat is one of the best brains who was working with Prashant of HDFC AMC, and post that he was managing one of the biggest treasuries of the country, which was 75,000 crore treasury. He was working with Reliance and he will also basically give his views on various sectors. He is one of the very well known guys for his views on debt side. And then we have Amit. I'll just introduce Amit to all of you. So Amit Gupta, all of you would have seen him more on channels. So Amit has total experience of over 2 decades in research expertise in equity, currency and commodities. He has won the India's Best Analyst Award in year 2012 and 2014, and it was awarded to him by erstwhile President of India. He was also on the advisory panel of NSE for the launch of new derivative products. He had attended seminars as spokesperson on our behalf across the country and abroad for the comprehensive coverage and for his exuberant knowledge on equity markets. He has also he started with handling the FIA desk for us, which was in Hong Kong. His opinion matters, and he has been giving regular opinions in equity markets on prime channels like CNBC, ET Now, and other ones. In terms of experience, Amit is a mechanical engineer and has an MBA, and he's basic CFO from Chartered Financial Analyst of India. And before I hand it over to Bharat, let me also introduce myself. My name is Manish Mehrotra. I'm the zonal head for West. I have a total experience of 28 years, and I have done my MBA from Jamnalal Bajaj Institute of Management Studies. So Bharat, over to you before we hand it over to Amit.
Thank you, Manish, and good evening, everyone. Welcome on a very good session, and I'm sure you will enjoy this. To start with, let me just briefly talk about where we are in terms of this entire economic setup, and I'm sure Amit will really get into detail whether it is a domestic economic setup or a global thing. But before that, when I just try to, put the context to the thing is that today we have seen decent correction from the peak. We have seen the entire economic setup, which was, very bullish to the fact that we started talking about tapering, we started talking about interest rate hikes, and from there we are into a situation where we are in midst of the interest rate cycle, where interest rates are getting normalized globally. Some of the central banks which were left behind, specifically ECB, they have joined us yesterday night, so they have also started raising rate. Two major economies which are still not yet joined this particular normalization process is Japan and China, and both these economies have their own challenges, which are not allowing them to move in synchronized way along with the other global economies. In this particular context, we need to also understand that we are coming into this particular event of an interest rate normalization on back of a prolonged interest cut cycle, or what we call extra, loose policy on back of, multiple events, whether it was financial crisis or COVID, or what we really happened was the temper tantrum. With all those things, we were not able to raise interest rates, and global central banks were forced to cut rate. Finally, because of the inflationary pressures, banks have started moving the rates back to normal. And along with this, there's the quantitative tightening which is happening. We are underway $95 billion of quantitative tightening by Fed. ECB stop buying bonds now. In that context, we will the way we got benefited from the extra flow of money in form of a loose monetary policy. Entire tightening of monetary policy is also expected to impact us on the other way in form of squeeze in terms of liquidity. Even though there are such a challenging period, and the fact that market is expected to remain volatile for next 6 months or so, we also need to understand that markets work on expectation. Market works on pricing the future expectations and moves way ahead of what really the events are coming. So today, when we talk about interest rate closer to 3% in USD, we are talking about a treasury rate of 3%, broadly pricing in a normalization of interest rate. India at 7.5%, broadly pricing in the fact that we will go back to say 6.5% in terms of overnight rate. So we don't need to wait for the entire monetary tightening process to get completed. Market will price in expectations and reach that particular level. On the same context, what we have really seen is with rising interest rate, expectation of recessions, and also the fact that the growth is going to suffer in the entire process of inflation fighting, we are also going to have impact on the PE multiples. So we have seen decent amount of PE multiple re-rating on back of higher cost of capital. And with those, we have seen 15 to 20% correction in the market from the peak. Now, where we are, what is expectation from here? How do we really see market going forward in India context and global context? I will invite Amit to come and explain us what's really he expect markets to do from here on. So,
Thanks,
Manish,
Bharat.
anything
Yeah.
else? Yeah.
Bharat, before we invite Amit, let me take some views from Kishore and Sanjeev in terms of what are the things which clients would have also expect Bharat to cover, or anything they want to add in. Kishore?
Yeah, I think you know definitely what is affecting our markets is also affecting other countries, right? It's inflation is a global phenomenon right now, and therefore I think having some insight into how the US Fed is looking at tackling inflation, I think would be a big help. Also, maybe a little commentary about the slide of the rupee against the dollar, and what are the implications of that is also something that I think it would be useful to hear from Amit.
Sure. Thanks, Kishore. Sanjeev, anything you want him to cover?
Thank you, Manish. Manish, so I think my expectation from the session would be one, we look at the headwinds on the macroeconomics. And, I think Bharat just spoke about the squeezing of liquidity in the tightening of monetary policy, as well as I think some of the factors that are of concern is the inflation, the crude prices, and the volatility which we've seen in the last, I think, 1 month or so. Plus, I think then when we get into the specifics of the portfolio, I understand, I think Amit has been working on the portfolio with digitization, formalization, China plus strategy, infra and consumption. And when we specifically look at some of these stock ideas that we are trying, how we are constructing the portfolio, if you could bring out these themes that we are working on. So that's it. Thank you.
Sure. Thanks, Sanjeev. And some other expectations, Amit, given that you have had one of the best journeys in terms of being one of the best derivative guys in the country, if you can also share with people in terms of how is the technical charts looking and what is the inference you are drawing from that, and how do people see markets from here. So over to you, Amit. I know we have taken some time. Thanks.
So thanks a lot. So I think because we have already seen a lot of volatility in the last 1.5 years, and obviously from October onwards, and then from February onwards, when the Russia-Ukraine thing started, the FI outflows actually have been very, very aggressive, and that is the reason we have seen, in most of the sectors, the profit booking has come, and most of the portfolios actually they have underperformed in the last 6 7 months. So the question is what to do now, because that is very, very important. And Bharat also said that market generally looks, what is going to happen in future. And so rather than reeling under the current volatile situation, we should also look at, what market has already started factoring in now and what it is looking beyond. So let us see. I have few slides I can share with you on the general, domestic scenario, what is happening. Very important, because ultimately we are forming the equity portfolios in the Indian markets. So if you see Nifty overall, which is our the basic index, whether you look at from the pre-COVID highs, it is 22% still higher. If you look at from the post-COVID highs, it is 18% lower. So we are commodity consumer nation. So generally people say that FI outflows are happening here more. So in that case, the decline in our index should be more severe. But if you see the commodity producers, for example, Brazil, Malaysia, Indonesia, and if you see the price performance of their indices vis-a-vis Nifty, so it is not like they have outperformed us very significantly. In fact, they have underperformed. So all of them have been negative from the pre-COVID highs, and we are still positive actually from those levels. From the post-COVID highs, yes, we are 18% down. Some of them are 19%, and still Brazil is around 25%. So if you look at the flows, so that shows the resilience in our market, and we need to understand this. In the coming slides also, we are trying to discuss what ultimately is leading to this particular resilience. Today we are at 16,700, and now 6 months back also we were at 16,700. So market is ultimately there only, and it is just spending time. It is more time correction, which is a healthy sign, because time correction is always a healthy sign once you have already moved up quite swiftly. If you see the FII flows in all the calendar years starting from 2020, India had seen very robust flows in that period. After the month of March, when the market declined, then obviously $24 billion of flows came actually in the Indian markets. 2021, we had seen almost $4 billion of flows. So flows continued, though with a little lower one. But 2022, we have seen very high outflow from the FII. So we have seen $30 billion of outflows. And if you see other nations, it may not be like that. But ultimately, our index has been still outperforming. So one of the reason that directly comes to my mind is because our domestic flows have remained very robust. The SIP flows have remained close to 11,000 crores on a monthly basis, and we have seen the more and more accounts have opened. Almost we were somewhere close to 5 crore or 4 crore numbers in India in terms of demat accounts. Now it has gone to 9 crore actually. So obviously this particular support has been there in the Indian equity markets, and that is one of the reasons why the volumes also have come up, whether it is equity or derivative segment. And the other is the equity markets resilience, especially Nifty and Sensex. Now, if you see some factors which are definitely supporting us on the domestic front, monsoon has been very important for India. We are ultimately agriculture driven economy. And if you see when the June started, there was some deficiency. That is the reason when we saw the sowing of rice in India, it was a laggard. But now it is picking up. In fact, now the monsoon has spread out across the nation, across the country. There may be some areas in eastern side where possibly the monsoon is still has to pick up, or some areas of northern side, but overall it has spread out very nicely. In the month of July, now we are almost 7% higher than the long-term average. So this is where I think any the segments around the agriculture space are going to recover, because whatever we are going to speak today, ultimately we have to boil down to the equity portfolio formation. You have seen some bouts of recovery in the FMCG sector recently, and this is one of the prime reason. We have seen, because of crude prices moving up, there were impact of the raw material prices on many sectors. So that already happened in the last 1 year. We have already seen the margin pressures coming in the sectors, but now these kind of tailwinds are providing the revenue growth. If the farmer's income increases, obviously the expenditure, the rural consumption, it will lead to growth in consumer, FMCG, those kind of sectors. The companies which have spread out and have a deep distribution towards the rural areas, they are obviously going to be benefited. Now, if you see the rainfall overall, the last 50 years average is here, and we are seeing this kind of rainfall right now, and this is in continuance of the last 3 years. That is also another positive actually. Generally, monsoon remains above long-term averages for two continuous years, and then we don't see that. But this time we have seen for the fourth year in running. And if I correctly remember, when we saw this in 2000 decade, then it continued for 5-6 years also. So it is also possible the following years also we may have a good monsoon. Now, if you see this particular cumulative rainfall, obviously this is again a comparison of the last 50 years. So this time we have 335 mm rainfall. Previously it used to be 294 mm on an average. So this particular slide at least gives you a glimpse that this is one positive aspect which is supporting the markets right now, and obviously some sectors which have come down, there you will start seeing the recovery. If you see the another important or something which is there before every one of us is inflation, because US inflation has moved up very fast. It is almost 9% above. If you see India inflation, we were also around 7.1% now, though a little lower than the last month. But the major component in our CPI inflation is the food and fuel inflation. They comprise of more than 50%. And now we are seeing the food inflation is tapering off. So in the last 2-3 months, we have seen these signs that because if you look at our government, they did the increase in interest rates, but ultimately they are also going with the fiscal measures. The government actually increased the duty or export, duty on wheat, and that is where we have seen the wheat prices came down more than 10%. Chicken prices recently we have seen they have declined by 10% in the last 15 days. In fact, the crude palm oil prices that has also declined. There was a news before that Indonesia is going to ban the export. Then we had seen a very sharp surge in palm oil. So obviously palm oil is used everywhere. If you look at in India, in any food and beverage or somewhere. So now when Indonesia continues to provide the palm oil prices, ultimately we have seen the palm oil has corrected by 20% from $1,700 to $1,350. Now in between, this is a sowing across the various crops. So if you look at pulses, cereals, sugarcane, jute, cotton, all of them, then the last year they have been little higher only, but rice is little lower. In fact, oil seeds also are little lower. So now we are seeing that some recovery is happening from this front because of the monsoon is spread out evenly across many regions. So this is a good news that food inflation is tapering off. In fact, recently we have seen some GST rate hike, and that also has 10 to 15 bips of impact on the inflation. But ultimately, we are seeing fruits and vegetable prices are tapering off. So it is an expectation inflation in India by the financial year ending, it can come down to 5.5% also. So now this is one thing very, very major. We have seen that there have been a lot of macro headwinds in the last 1 year. We have seen everything, interest rate hike, high inflation, Russia-Ukraine war, crude moving up. But when we look at domestic index earnings, we are seeing that it is giving a true breakout of the last 7 years. If you see from 2014 till 2020, the EPS of Nifty was stagnant. It was 430 rupees continuously. And this was the period when there was no commodity surge. Generally, people say in India, when the commodities are moving up, the earnings decline. But actually, you see previously also when the commodities have moved up, the earnings have recovered. 2003 2008 is the period when China was building up the cities. There was a big demand for metals, materials. In that period also we saw the Indian earnings grew by 26% of CAGR, and Nifty moved up from 1000 to 6000 within a period of 5 years. I'm not saying we are going to have that kind of move this time also, because the multiples are in double digit. That time the multiples were in single digit. But if you see this particular move of EPS on every quarterly basis, it is continuously up. So when the EPS is moving up, price is coming down, ultimately the price to earning contracts, and which creates a platform for investment. Because when we look at the month of October, so that time the price to earning in India was quite steep. Obviously, that was obviously a question before everyone, that market has moved up very swiftly. So PE levels were very swift. So it was almost 23 times price to earning in the month of October. But with EPS continuously moving up, and this is a 1 year old EPS which we have put in this particular chart. If you see, the ultimately the PE levels came down to 18. In fact, when it was closer to 15,000, it was closer to 17 times 1 year forward earnings. So this is where the big contraction has happened. There may be a more time correction possible till the situation of Russia Ukraine war is not sorting out. We may possibly see some kind of pullback in crude, which can create again the short term problems. But what we understand, because we don't have an answer to those questions, when ultimately the war is going to stop, you and me don't know. What we understand is that correction has already happened, valuations have already normalized. Now here, even if the correction comes, if I am investing at 15,000, 16,000 levels after the price to earning contraction, and I am looking for a period of 3 to 5 years, it makes sense. Rather than buying again above 18,000, it makes sense. When the market has corrected, you invest, because the earnings of the index are improving. And please remember, when the index earnings are improving, there are many sectors which were not performing in the last 10 12 years, and their earnings were stagnant. Those sectors have started seeing the tailwind of earnings. I will discuss this actually in the following slides, when we will come to our flagship product, ACE equity portfolio, which is going to be a prime discussion actually today. Now, this is again, we have tried to see on a trailing EPS basis how the valuations are panning out, because trailing EPS is something which is actually happening. If you see the last 12-month EPS, it is actually out. And on that basis, when we look at how the price to earning in India is panning out, so this is where it is. It is almost reaching to the last 10 12 years lows. And the reason is very simple. Even though we have not seen a big correction in index, but we have seen a big spike in the EPS. So price to earning, the denominator is moving up. So ultimately, the price to earning is coming down. Now, this is very, very important, factor to understand, because banking in India has a very high weight in the index. When we talk about BFSI, we have 38% of weight in the index. So it is very, very important to understand what's happening to this core sector. When banking starts performing, ultimately Nifty starts making the new highs. This is what we have seen before also. So let us understand banking. So if you see banking sector in India, I feel there are two major pillars to banking. One is the net NPAs should start coming down, then it gives a boost to the banking space. And another one is the credit growth should start moving higher. So when we talk about the net NPAs and compare with the last 4 5 years, yes, the NPAs have come down. So if you see this particular period in 2018, when there was a global slowdown and we had a total outstanding loan book in banks of 100 lakh crores, that time the NPAs were 12 lakh crores, almost close to 12 lakh crores. Now the total outstanding loan book in India for the bank's aggregate basis is 120 lakh crores, and you have NPAs of close to 6 lakh crores. So that means the NPAs have come down drastically, despite the fact you have already seen DHFL, IL&FS, Yes Bank, all of these particular events happened. Banks became cautious. We have seen the provisioning in the banks have moved up. Provisioning coverage ratio now in the larger banks is 75%. The slippages are coming down. The credit cost for the bigger banks now is less than 1%. So this is a good sign. And this is where the another pillar, which is also very important, is the credit growth. So when the NPAs came down, banking sector made the bottom, but it was not able to perform because the credit growth was not picking up. Last year, we had credit growth in India just around 5%. So that time it looked like the corporates, they don't want money. But eventually now the growth is coming. Last 2 quarters, there is an excellent performance or pullback in the credit growth in India. Now it has moved to almost 14% if you look at very, very recent numbers of July. So where it was 5% and now it is coming closer to 14%. I think this is a remarkable recovery. And why it is happening, please understand there are few factors behind this. When we talk about higher inflationary scenario, generally the working capital requirement of the corporates also increases. That leads to higher credit growth. The bond yields in the market have moved up very fast than the actual interest rate increase. For example, in India, the bond yields are showing, 10-year yield is showing 7.5%, and actual interest rates are 4.9%. If you look at the repo rate, in US, the actual rates are 1.75%, but bond yields are showing something else, 3.5%. So when a corporate wants to raise a money through commercial papers, ultimately they have to float them, but the bond yields are very high. So they have to incur more cost while paying the interest, because ultimately they will be the borrowers when they are raising money. So they go back to banks and borrow money actually from the bank. So this is where the bank's credit growth increases. Third, another important factor is when we were coming out of pandemic, the current capacity utilization in the bank in the market was 60% among the corporates. And now this has moved to 74.5%. So it is very important when the Capex cycle, when we talk about the private Capex cycle, why it is not coming up? It is basically the government public Capex, which is more driving the infrastructure sectors right now, which is driving whatever credit growth in the banks. And if you see the indications of the private Capex, they are somewhat coming now. Because when your current capacity utilization increases to a certain limit, then you go for a Capex. Right? Your demand leads to higher capacity utilization, and then you create the new field, new brown field or green field, whatever. So this is where, if you see the current capacity utilization, it has now 74.5%. From 60%, it has moved up. So this is the mean number. So there will be sectors which are much higher. So for example, metals, cement, chemicals, they are around 85 or 80% now. And that is where you have already seen the Capex announcements. All the metal companies combined, they have announced around 1 lakh crores of Capex. So this is where ultimately it benefits banks, and banks credit growth starts coming up. Though metal companies, they are also sitting in good profits. So this 30% correction is fine, but the way the metal companies actually have performed so far, it is significant. If you look at last 2-3 years back, the debt component in the whole metal space was 3 lakh crores. The EBITDA was 50,000 crores. So when we used to look at debt to EBITDA in the metal space, it was 6:1, 6 times, much higher. But now, just last year, when the metal prices were higher, we saw the EBITDA moved from 50,000 crores to 1.5 lakh crores, and debt declined from 3 lakh crores to 1.5 lakh crores. So debt to EBITDA became 1. And if you see after this correction, the current position, debt is 1.5 lakh crores, but EBITDA now has slightly come down by 20,000 or 25,000 crores. But still, the position is much better than before. So this is where these companies are in a Capex mood now. And this is, they are first of all, they are spending through internal accruals, but then they are going for the banks for credit growth. PMI services, which is a sign of manufacturing, the services in India, because there are two components, manufacturing and services. Manufacturing is around 54 in India, and services is reaching to 60. Anything above 50 means expansion. So services are expanding very fast in India now once the economy is opening up. There are diminishing signs of Omicron, and we have ultimately started seeing there are many sectors like hotels, like travel, tourism. So they are opening up. People have started going to offices, and this is where the services part is expanding. So there are new things which come up and which should be part of your portfolios when you are looking at equity. And this is all what we are looking at when we are forming an ACE equity portfolio for all of you. So this is one factor which is helping the government. In fact, this factor is always surpassing what government says in the budget. So last year in the budget, government said that GST inflows on a monthly basis will be 1.05 lakh crores. But actually this number came out to be 1.24 lakh crores. So total inflow of GST last year was 14.83 lakh crores, which is 30% year-on-year jump. And this year now, the government is talking about 1.3 lakh crores on a monthly basis inflow. And this figure already you are seeing in the last 2-3 months now, it is consistently coming above 1.4 lakh crores. So again, it is surpassing the expectations what government is giving actually in the budget. It's a very positive sign. And this is what giving, room for through the government to cut the VAT prices, what they have done actually in the petrol and diesel actually before. So this is where the spending comes for infrastructure also. Nowadays, if you look at the one of the highest infrastructure by the government, it is going into roads. Previously, we used to see 17 kilometers per day or 18 kilometers per day of road construction. Nowadays, it is happening 40 kilometers per day of road construction. And it is not like 4-lane highways are being built up. It is 8-lane highways which are being built up. So you can understand the productivity on the same area of land. So this is what happening actually on the infra front, and that is one of the reason why capital goods stocks have started performing recently. Capital goods, when we spoke with the companies, we came to know it is an 80% jump in the order book actually in India from the government. So this is what, and this is what actually leading, and this is where we are benefiting because we already have capital goods in our portfolios. Now, I think this is another important thing that you can take a notice of. Despite all the macro headwinds that we are hearing, actually in India, there are many industries which are making the all-time highs. You look at petroleum refinery, which is making the all-time high. You look at fertilizer production, steel production, cement production, electricity generation. All of them are making the new highs. So this is really a positive surprise actually that we, when we look at India perspective, the something different is happening from the industry front. So obviously, when a macro headwind comes, it does impact, but ultimately market follows what your own domestic economy is talking about. And I think this is what the projection I'm showing you. So now little bit about some global factors also, because the major villain in the market is dollar index. If you see after every 20 years we have seen there has been an up cycle in dollar. It happened in 80-81 when it moved up to 160 levels, and then it happened in 2000-2001 when it moved to 120 levels. Now it has happened after another 20 years in 2022 when it has moved to 100 plus levels. So every time it has made a new but lower top. So 160, then 120, and we don't know where it is going to make it top here. So that is what is going to be seen, but it has created problem because when dollar moves up, it's a sign of risk of sentiment, and emerging markets, FII start, taking out money. That is what we have seen, and rupee has depreciated. It is definitely a sign of worry for some time from the FII flows perspective. But we also need to understand if somebody is sitting outside and rupee depreciates to 81 or 82, let us suppose, it becomes a very lucrative situation for them to put money again in India when your domestic setup is very strong. So this is what can happen anytime whenever rupee goes to 80, 81 or 82. I mean, these kind you cannot predict which will be the exact level, but it will be very lucrative from the FII's perspective. So 4 major reasons for expected what generally people are talking about now after the interest rate hike. after the front loading of interest rates. 75 bips of rate hike in US is obviously is not a small thing. In a single meeting, they announce 75 bips, and in the next meeting, what people are projecting another 1% rate hike. So these things have already come up, and bond yields have already taken up these expectations. But ultimately, there are four fundamental things which are happening. There are supply chain disruptions, there are labor shortages, there is an elevated material cost, commodity inflation, then there is a sharp increase in interest rate. So these are the four prime things which everyone is talking about when we talk about global scenario right now. So let us see how these things are panning out. If you see from the commodity perspective, commodity inflation perspective, recently by the virtue of dollar being appreciated, by the virtue of some recessionary talks coming off, we have seen that the commodities have seen a knockoff. So they have fallen. All the, whether it is aluminum or copper or steel, so around 30% or 35% of correction we have seen. Even iron ore. So iron ore is basically the raw material to the steel companies. So when iron ore falls, it is good for steel companies actually. But output prices have also fallen. So this is how when the commodities have come down, going forward, the inflation numbers which are going to come out and which were higher because of higher commodity prices, you may see some kind of peaking out going forward. So this is a blessing in disguise that when the commodities have started coming down, possibly this particular inflation of US, which has not come off yet, it is 9.1%, which is very steep, one of the highest in the last 40 years. It may take some, may see some peaking out. There are another 2-3 reasons behind the US inflation surge that we had seen before. One was the wage inflation, and wage inflation was higher because the people were not coming for jobs. The labor participation was very low. It is improving, but it is improving slowly. But eventually, whenever it starts moving higher, this wage inflation will come off. The another part of inflation surge in US was the used car prices. The used car prices, because there was a semiconductor inavailability, it was not available because Russia-Ukraine war was there. There were lockdowns in China. So that led to the higher used car, because in US they cannot live without cars. In India we can live without cars, but not in US. So their used prior cars actually started seeing a jump. So we saw 68% of hike in the used car prices. But now you see the things other ways, because last year same period the used car prices started moving up, and after 1 year, when you start calculating the inflation, then this number, because of a higher base effect, will start coming down. And now China is also opening up. So semiconductor availability will increase. That is the reason why the auto companies in the month of June, they have posted good results, because actual execution of sales happened. 26% of year-on-year jump we saw in the month of June. And that is where you have started seeing the auto companies started bouncing back, because they were available at good PE levels. This is another thing that while forming the equity portfolios, we need to look at. Not everything which is at a higher PE, it is risky, because when the interest rates are moving up, you need to also create the positions which are at lower PE levels, like for example, auto stocks, which could not participate in the last 2 years now, but some kind of recovery is seen. So when I talk about the interest rates in US, I think the bond yields have already assumed the interest rate hike into even in 2023 or 22 ending, because this is the dot plot of the US Fed governors. The median, which is shown by the green line, it shows you 3.4% of interest rate increase expected in 2022, and bond yields have already gone to 3.5%. So this is where actually the bond yields have already moved up swiftly. Our expectation is now going forward from 1.75%, even if the interest rates in US go to 3.5%, that means almost double. Another 1% they are talking about, there may be another 75 bips afterwards. But because bond yields have already moved up in anticipation of this happening, you will see more range bound scenario happening for bond yields, which is good for equity markets, because equity markets don't like a sharp move in the bond yields. Historically, whenever it has happened, equity markets have come down, and it came down when it was happening. So if you see more consolidation in the bond yields, it is possible that equity markets become more stock specific and opportunities will come for your portfolios. So finally, on the macro front, whatever rate hike cycles have happened before, like in the last 2 decades, this cycle happened in 2004, 2006. So this was a 4% interest rate increase in this particular cycle. This particular cycle, there was an interest rate increase of 2.25%. Whenever these interest rate cycles started, the bond yields moved up before or near the first or second rate hikes. But then afterwards, even if the rate hikes happened, bond yields did not participate, and this is where the equity markets moved up. This is what I was discussing just now. So if you say in this particular cycle of 2004, 2006, we had seen that during the actual rate hike cycle, bond yields moved up only by 39 bips from 4.58% to 4.97%. And equity markets gave you a substantial move actually on the higher side. And then 2015, 2018, the bond yields move again was very restricted. It moved up only by 79 bips when the actual rate hike cycle happened. And that is where markets again started performing. So this time you have another variable of Russia-Ukraine war, which we don't have an answer. Whenever some kind of negativity comes from there, markets will find jitters. But this is one variable that you need to understand very clearly about the yields and the equity markets correlation. So if you look at rupee has depreciated, but against some of the developed nations, it has appreciated. Euro has fallen more, yen has fallen more. Euro has fallen because there was a weak economy which was panning out. They did not have a courage to increase the interest rates despite the inflation moving up. So very recently they have increased the interest rates now. So after the interest rates have increased, it is possible euro can see some kind of appreciation because euro has 60% weight in dollar index. When euro falls, dollar moves up. When euro appreciates, dollar starts tapering off. So we have to see if euro little bit appreciates from here or not. But yes, euro depreciation led to dollar appreciation, which led to rupee depreciation in the recent period. That clearly you can see. But rupee depreciation was more against dollar but was lesser against euro or yen, and that is where rupee has appreciated against these currencies. So this is where some of the IT companies they have faced pressure because cross currency losses have come actually for them because they have business in Japan, they have business in Britain, they have business in Europe. So obviously when our currency is appreciating against those currencies, so there is a cross currency 2.5% of loss most of the IT companies have booked actually. Now this is finally for the equity markets, one indication comes from the fear gaze. If you look at the volatility in Indian markets and US markets, we have seen that they have started coming down. And it is really surprising that Indian markets volatility has come below 18%. It is around 16.5% this time. And US volatility also has started coming down. So this possibly is happening because ECB increased the rates, which it was not doing so far. You can see Fed rates were 1.75, BOE rates were somewhere here, but now ECB has started the rates. So if ECB is increasing the rates, possibly dollar may find some trouble near 108 or 110, and we have seen previously that 120 was the level which they made a top in 2001. So we don't know at which level that kind of top formation can happen. So that is something answer is hidden in the future only, but this is actually what's happening. So now coming to ACE equity portfolio, I think very interesting times for stock specifics because stocks have come down, things are available cheaper, and this is where your long-term investment should go now in the markets. If you see ACE equity portfolio construction, basically it is a 20-30 stocks portfolio where we have an optimal diversification for you. We believe with 25, 30 stocks, you can create a much better portfolio with diversified sectors. These are mostly the high conviction ideas. We have a deep research pool from where we come out with the ideas actually for investment. And these high conviction ideas are focused on market leaders across the market caps. So market leader is very, very important, whether you look at leaders or challengers, but at least the top two in the sector. Why it is important? Because this is a high inflationary scenario. In a high inflationary scenario, the companies which are able to increase the market share, ultimately when the tide turns, these companies they benefit. Their revenue generation becomes very fast because they have already increased their market share, and this is the focus of ACE equity portfolio. We hold the companies till business continues to remain what we are expecting. This is ultimately our motive. We can make some changes from time to time when the stock prices have moved up swiftly than what the earnings are projecting. Then we can always do some kind of weight change in the portfolio that is really helpful to create alpha. Now, two major factors among the market leaders in this portfolio. We look for two categories. One is the high growth companies, which are consistently giving EPS of more than 15% and ROCE of more than 20%. But there are other set of stocks which comes under value space, because when you are in a higher interest rate trajectory, as I discussed before, you cannot have all the stocks which are high growth because their price to earning can remain elevated. So because the index earnings have started growing now, there are sectors which were not performing in the last 10-12 years because their earnings were not performing. Now we have seen the tailwinds of increase in the EPS in those sectors, whether it is telecom sector, whether it is corporate linked banks, whether it is capital goods. All of these sectors are seeing the revival. And that is a reason actually when you are forming the equity portfolios, it is must to have both of these things in the portfolio now. Will have a balanced price to equity. When the market falls, your fall will be lesser. If you look at in the month of January, when we had seen a fall and indices declined by 4-5%, this portfolio declined by only 1% because of this particular reason. So we have a combination of large caps, mid caps, more large caps right now what we have in the portfolio. So this is how the construct. If you see few examples from the high growth space, so Titan, PI Industries, SRF, Havels, so these companies qualify for now the continuous EPS growth projection and the ROAS of more than 20%. All of them are leaders in their segments. If you look at Titan, in the organized space, now their market share has grown from 6% to 7%. This is one of the biggest organized players now in the jewelry segment. Hallmarking is made compulsory. And that is the reason they are coming on the same platform like other, unorganized players, the big jewelers in the regional markets. Previously, people used to bring gold in the market, but there was not proper invoicing. But now with the help of hallmarking, there will be a proper invoicing. And this is where all of them are now coming closer on the same platform. This is the advantage to Titan. You look at PI Industries, this is an agrochemical company, but it is in custom synthesis. The concepts of custom synthesis, CRAMS, they are going to emerge very fast in India. It is something like what was happening to the technology way back in 2000. Because there are a lot of orders which are coming from the big R&D companies or agrochemical companies to these companies in India now. You look at the companies like, PI Industries or Syngene in the pharma CRAMS space. PI is in the agrochemical space. So they have a very sticky customer base. When we see the crop prices also relatively higher, that is going to benefit the farmers. There is a lot of acreage which is happening nowadays. For example, because of the higher fossil fuel, we are going to see more blending of ethanol now. So far, what the government has spoken about, what target they had for 2022, they are going to do the blending of ethanol. They have already done 10% now, which used to be done, which was supposed to be done by 2022. Another 3 years, they are going to move from 10% to 20%. So there is going to be more acreage of sugarcane and corn kind of crops from where ethanol can be procured, which is going to benefit farmers. So the ecosystem around agriculture, because monsoon is also better, these companies can prosper going ahead. SRF is one of those stocks which has given us almost 150% of return in the portfolio. We took the stock around 4,500 or close to that, and it moved to 12,000. And there is a significant jump in the market share in this particular mid cap stock. Because previously what was happening, if you look at the ACs in India, because AC is a segment which is very, very under penetrated in India. Hardly 6% penetration we have. You look at fan, it is 85% or 90% penetrated. But AC is hardly 6% penetrated. The only other segment is microwave oven, which is 5% penetrated. So when I talk about AC, if previously ACs were going outside, the refrigerant gases were getting assembled, but then government put a ban. Government said you need to do it in India. And then this is where the fluorochemical providers, the R134A gas providers, R32 gas providers, their market share increased. All of these gases are used in ACs. So we saw a very sharp jump. The margins improved. In fact, it is also in the packaging business where we saw a substantial jump in the margins. So all of these things are coming good. The recent numbers also have been very encouraging from SRF. We have tapered some of the weightage because stock had moved higher, but still we are holding the stock in the portfolio. Havells is another one in the FMEG space, fast moving electrical goods, where there are few companies who have built up a very good brand. Now Havells brand, you can understand, once you look at lighting, you look at fixtures, you look at switch gears, and when new registrations are happening for new houses in most of the tier 2 cities, also in the urban areas also, there will be more demand coming for lightings and switch gears. And when I talk about cables and wires, obviously that demand also flourish with the new construction coming up and the new infrastructure which is happening. So Havells, one peculiar thing is they have increased the prices, but even then their volume growth has not stopped. In this quarter also, there has been some tapering of EBITDA margins because obviously the raw material cost has moved higher. But we saw that the revenue growth has been continuously moving up. So this is something, which will drive the stocks going forward, and that is what you need to have when you look at the high growth stocks. When I come to the value stocks, one of the recent pick that we have taken is Tata Communication after the recent correction. Now, why Tata Communication? This is another market leader in their segment. Their cables are going under the sea from one nation to another nation. 30% of world internet goes through their cables. What was the problem then? The problem was that the voice revenues came down, but data revenues increased. So overall revenues were stagnant in the last 5 years. And that is the reason stock is available at such cheap valuations. And Tata Sons acquired the company from the government last year. And after TCS, this is the second highest holding of Tata Sons in any company in India. In TCS, they hold 72%. In this company, they hold 59%. And now, if you look at the recovery, they have moved into F1 car race, where they are collecting the data of all the cars at different points of interval, and they are giving that particular information to the owner. So there are new ways of revenues which this company is trying for at a ROAS of 25%. The other thing under the Tatas, if you look at the companies in Tata Group, they are continuously deleveraging the balance sheet. So here also the debt component was higher. So it was 11,000, 12,000 crores. But every quarter they are reducing the debt. Now it is 6,000 crores of debt which is left in the company. In this quarter also, because they are generating around 17,000 crores of revenues, and out of this 2,000 crore is the free cash flow, and they are just paying the debt. So this quarter also we have seen 600 crores of debt has been paid off. So this is what can create a meaningful jump in the stock going forward, and this is what we are looking at when we talk about the value segment in ACE equity portfolio. So why market leaders are required? Obviously, I have discussed that these companies, they create an all-weather portfolio because you are mixing high growth as well as value. So when the market falls, your fall is lesser. And when even if the market is stagnating, these value stocks starts performing very good. And even if the market starts moving up eventually, because it's a double digit multiple market, you will not see a very sharp move now. You will see a gradual moves. So there also such kind of stocks participate like anything. You can see SBI. I had SBI actually in the value pick. 450 rupees is the price of SBI if you look at the standalone value right now. And if you look at all the subsidiaries of SBI, they are giving a value of 192 rupees even after taking 20% of discount, holding discount. So at 450, you were getting 192 rupees free actually on the stock. And that was happening when the slippage ratio was coming down, the provisioning coverage ratio was higher, NPS was obviously lower, and credit growth now has gone to 11%. So this is something that you keep to understand after forming such portfolios. So market leaders, they have a superior product profile, they have a high bargaining power and consistent track record. These are the companies which can create tailwinds for multi-year structural growth. These companies, they can hire better talent. They have access to lower cost of capital. They can secure discounts, price discounts. They can engage with partners on a preferential basis and they can consolidate the market. I think this is very, very crucial when we talk about market leaders. And ultimately, these are the companies which increase the market share. And in a higher inflationary scenario, in a tough scenario, they increase the market share. And then going forward, they can pass on the cost also to the customers. So these are the basic things that we look at in a business. Ultimately, you look at from the FII perspective. Why an FII put money in Indian companies? Because they want EPS growth. They want ROE surge. So this is where a company which has a strong pricing power and a company which has higher ROE trajectory, they are going to be benefited with those flows. Obviously, the track record of the promoters is very much required. Everyone looks at, even an ultra HNI client, when he's investing, he will look at the track record of the promoters. You look at the corporate governance. If everything looks fine, that is where you start putting your money. When the businesses are at an inflection point of bigger breakouts, structural growth, that is what actually you need to look at, because this is where you can create multi-baggers in your portfolio. So obviously the strong cash flows and manageable debt position. In fact, along with manageable debt position, it is also important what I spoke about in Tata Communication. You should have the proper cash flows which can reduce the debt. So that kind of intention has to be there from the promoter group, that we have to reduce the debt in the company. That creates alpha and that creates more beta actually in the stock. So obviously, lastly, the government reforms. Right now, what we know about government reforms is DFC, which is going to come up, the China Plus One, which is automatically happening, because if you look at the corporates outside after the pandemic, they are looking for other opportunities other than China. So PLI benefits have come from the government and they are inviting everyone to start manufacturing in India. So this is what is leading, and this is what actually we also look at when we are taking companies in ACE equity portfolio. These are the 5 major themes behind our stock picking. We look at digitization, we look at formalization, which is nothing but unorganized to organized move. We look at India as a global manufacturing hub, which is actually happening now. Samsung is already there in Noida, Apple has already come in, Wistron and all, they have already come in. And we are seeing more and more companies now, slowly they are starting the manufacturing here. Who will be the beneficiary of this? Basically 2 components, the vendor companies in India who will start getting, the business, and obviously the banks also who will start getting the credit growth. Infra and housing Capex. So obviously so far it is more government which is helping with the public Capex, but going forward the private Capex also, what as I said about the current capacity utilization, there are green shoots of that coming up. Consumption boom in coming decade. This is another important, in fact, very important from the India perspective. Let us touch upon all of these points in brief. If you look at digitization, generally, what comes to our mind is the IT services companies. But no, we have taken three components here. One is obviously the IT services. The other is the industrial automation components. You are in a higher inflationary scenario. Raw material cost is higher, challenging environment for the corporates. So what will they do? They will optimize the cost. So if they have to optimize the cost, they have to go for industrial automation. This is where the companies like ABB, Siemens, they come up. I'm just giving you examples from where we can start picking the stocks. If you look at the other segment is the stocks where technology adoption is very fast. So this is where, if I give you an example, you look at the general insurance companies, ICICI Lombard, for example, which is part of our portfolio. Now the total AUM of general insurance industry is 2.02 lakh crores, out of which 1.25 lakh crores is held by the private insurers. A substantial part, their market share has increased. They have taken the business from the PSUs because they are adopting the technology very fast. So there are three components to digitization. Either you go in a services where your L&T technology or TCS or Infosys kind of companies comes, or you go for the industrial automation, right? Where ABB, Siemens or this kind of companies come, and they are already talking about 80% jump in orders from India. If you look at the other one is the technology adoption. So few things about India, digitization is picking up very fast. If you see the internet users in India now in the last 5 years, so they have been doubled. They have moved to almost 77 crore. If you look at the cost of data in India is one of the lowest in the world. Still, it is one of the lowest. Though we have already started seeing the tariff hike, the prepaid prices have increased by 22%, which is good for telecom companies. But still, it is one of the lowest. If you compare with China, which is $0.71, we are at $0.09 per GB cost. In fact, there are companies in South Africa where you will find $27 per GB cost. In US, it is $3.3 per GB cost. So India obviously is the beneficiary, and this is the reason why data consumption has increased so fast in India. If you look at the mobile applications download in India, it has reached to 30 billion. If you compare with US, it is much higher. Yes, China, we have seen 98 billion of application downloads. But the consumption of data every month by Indian mobile users now has gone to 12 gigabytes. If you compare now with China, it has been close to 11.5. And if you compare with other economies, it is substantially higher. So data consumption is picking up very fast. And this is where a lot of opportunities are there now. So digital economy is expected to contribute 20% of our country's GDP now, compared with just 8% in financial year 21. If you look at China, it is 40% of the GDP. So this particular aspect of digitization is picking up in India now. After pandemic, yes, it is picking up more. We have already seen it has reached to the rural villages also, tier 2 cities also. So there the acceptance has increased. So there is a lot more now for the corporates, the channels that they can use. And this is where you need to understand what kind of stocks have to be taken in the portfolio. IT exports in India have already surpassed the oil bill, but when crude remains around $80-90. If crude goes much higher, obviously the oil import will increase, but around $80-90, it had surpassed the oil import bill. So this is one positive, and that is the reason the current account deficit in India remain around 1.2 or 1.5% for long minus. Now, telecom companies obviously are going to be benefited with that more data use. We have already seen their focus is on the ARPUs now. So ARPU in last year were around 130. Now the ARPUs are crossing 170. If you look at Bharti, the ARPUs have already reached to 177 around. So this is one important feature, that we are looking at, and these companies were available cheaper. If you look at another thing which is attached here, when I talk about MSCI weight, because I was also handling the Hong Kong desk of FIIs, we understand, we have cracked this mathematics actually, that how the weights are increasing in MSCI. So when Bharti Airtel was around 600 levels, we had seen the promoters had sold some stake. So free float market cap of Bharti Airtel increased. The FII free float also increased. So we increased the positions in Bharti Airtel actually that time around 550, 560 levels. Because we understand that now the weight of the stock is going to be increased in MSCI now because of this particular feature. It was already part of the index. And afterwards from 1.2% it increased to 2.4%. And now you can see stock has moved up. So it does not come below 600 now. So this is where, your weightage is increasing. You and me may have possibly the same 3-4 stocks, but the way you increase or decrease the weights, that also defines the alpha in the portfolio. Formalization of economy, when we talk about, this is basically something which did not pick up at the time of GST, which did not pick up that much at the time of demonetization, but actually it has picked up near the pandemic. If you see many unorganized businesses, the businesses which are there in the unorganized markets, they are moving into the organized space. Inflation is higher, raw material cost is higher, government is very, very compliant on the taxes. So ultimately, the business is moving. So this is where there are companies which are going to be benefited, and we have shortlisted many sectors where the unorganized market is 60-70%. Jewelry market is 60-70%. I just give you examples here. If you look at jewelry market, you can see how the organized market now, is increasing. So from 23% in financial year 16, this organized market is somewhere around 42% now, and unorganized is decreasing. So this is where the companies which are there in the organized market like Titan, they are going to be benefited, and their market share obviously is increasing. As I said, from 6%, it is moving towards 7% now. Another one, just take another example of foods and grocery retail. This is also highly unorganized market in India. You have a lot of kirana shops and all. Now you look at the size of organized food and grocery in India in financial year 13, where it was and where it is now. So organized part has increased. So organized FNG penetration, which was hardly 1.9% 7-9 years before, now it is 7.3%. So this is where the companies in this particular domain, obviously you need to look at the valuations also. That is where it throws an opportunity that you can pick in the portfolio. When I look at India as a global manufacturing hub, I think few things come to my mind. First of all, there is an automatic shift of corporates away from China. Our PLI benefit is one of the best reform by the government I have seen, which has seen so much of acceptance in India. There is lot more to gain when we start manufacturing in India. If you look at the agrochemicals market share of China, it is 17% and India is very low, 6%. Pharma APIs, China has 11% of market share, India is hardly 4%. Dyes and pigments, China has 12%. So there is a substantial market share China has built up over the years in many segments, and now India has an opportunity, because ultimately we have seen the variables which were attached with China, like very low wage cost, government support, ultimately at the electricity cost, power cost, lot of mining was happening, so energy cost was also lower. Things are reverting actually there, but finally above all of this, the mindset of the corporates after the pandemic, they have started shifting, and this is where our government PLI, which is a substitution to the import, they say you are importing, you create here, and once you reach a certain level, you start exporting also. So both the things are helping now. Export also has picked up, we have seen. And if you see the banking credit in a process, in US, the banking credit, is 161%. In India, it is hardly 57%. It is percentage to GDP. The credit growth, obviously, we have already discussed how it has increased in India recently. The GDP has gone to $3.17 trillion in India, and the Indian exports have also moved very swiftly in the recent period. So for example, you look at electronics market, we were net importers, now we are net exporters. So likewise, going forward, there will be other segments also which will come in the more and more export category for India, and I think this is good for GDP. If you look at, once India has crossed $3 trillion GDP, you look at US, you look at Japan, you look at China, when they crossed $3 trillion, they took 6-7 years, and then they, became double. also moved much higher. So this is what the focus, this is what going to happen in India from $3 trillion to $5 trillion and beyond. So in the coming 5 or 6 years, this is what can happen. And in that scenario, the manufacturing as a percentage of GDP in India, along with the services, is one segment which can revive. And we have seen when the GDP was improving in those countries in that period, the market cap also became 2 to 3 times. So that is what an opportunity for India actually from here onwards. And this is where the declines which have come, part of your investment should start flowing now. So this is SBI, which I have already discussed, that the after giving 20% of holding company discount, 183 around or 190 around, the price is coming actually for the subsidiaries, which is available free if you are buying the stock near 450 rupees, because its standalone value was coming around 450 rupees. Asset quality has improved. If you see the GNPA and NNPA, which is a net NPA, they have declined. If you compare with financial year 18, it has substantially declined. So this is, and the valuations also. I think one of the best thing that we look at in banks is ROA, return on assets. So SBI is somewhere around 0.7 and looking for 1%. The private banks, they are somewhere close to 2% now. So which is very healthy from the bank's perspective. Infra and housing capex. So this is what we have seen when this government came in 2014. It was 1.5, 1.6% of GDP. This is the public capex, government capex. But now it has increased to 2.9% of GDP as per the recent budget announcement by the government. So this has been going into renewables. This is going into data centers. This is going into metros. This is going into power transmission. This is going into more mining. So there are opportunities which are coming. In fact, recently I had met a management. So in the capital goods, they told us that sugar is one of the sector which is providing orders to the capital goods. You know, renewables is another sector, data centers is another sector. So there are, you can line up these kind of sectors now, like electric vehicles is another sector. So where the things are growing faster, and this is where the more and more orders are coming actually to these companies now. So this is where more capex is going. DFC, this is one corridor which is going to be ready now, which is from west to north. So west to north. Next will be from Gujarat to GNPT. That will be the next one. So this is the first one which is going to be ready, and this is where the things are going to be more easy now going forward. So I think the 7 to 8 days what used to happen in train, it will happen very fast, and this will revolutionize the industry sector actually going forward. And this is where companies have started participating. If you look at this particular expansion in DFC, we took one company in the portfolio, SKF, after the recent market correction, because this manufacturing activity in India, whether it is happening by the government or whether they are investing in railways or they are looking for more wagons, Vande Bharat train, what they are talking about, or the DFC corridor, more manufacturing obviously is going to happen. So bearing companies are going to be used, correct? And when we look at automobile, so in automobile also you use the bearing companies. So automobile had come down and we believe it was close to the bottom. And as I said, with the availability of semiconductors, we have started seeing the reversal in the automobile. And this is where bearing companies are, I think, have a good time going forward also. So on corrections, you can take it. And these are the efficient, providers of the goods, and the profitability is zooming actually in these companies right now. So this is another space or stock that we have, taken under our high growth as well as value segments. So that comes under the value segment because it is reviving now. L&T, this is the one actually which has not been performing. In fact, the market cap of L&T remain around 1,80,000 crores for a long 3-4 years now. But now the things are changing. Why the things are changing? Because if you look at the debt to equity of L&T, which used to be 1.25, now it is 0.5. You look at the working capital to sales, which used to be 23.5%, now it is 20%. The non-core assets like thermal plant, hydro plant, They had a stake in IDPL of 51%. They are selling it off. They are very clear actually about the cash flows. The Hyderabad Metro project, which was a laggard actually on the books of L&T, so they have refinanced it. But again, we have seen good footsteps in the urban, in the Hyderabad metros. So that problem is is getting little bit sorted out now. So L&T overall is coming out is as a good equation. If you look at the crude prices, so any infra company is there which is the beneficiary of even higher crude prices, it is L&T. Because when the crude is relatively stable, we see good order inflows from the Middle East to L&T. Whether it is solar, whether it is transmission lines, pipelines, or infra, there are good number of orders which come to L&T actually in a stable crude scenario. So this is where the EPS of L&T is going to be 80 now very fast. I think this is where the kick is coming, and all of these segments of L&T are going to grow. I think 2600, 2700, the value is coming for this particular stock. It declined recently, which created an opportunity. We had increased the weight in the stock in the portfolio. So last theme that we have is consumption boom. Why we talk about consumption boom going forward for the coming decade? Because India per capita GDP has crossed $2,000. It is $2,100 now. When it has happened, for example, when it happened with China in 2006, we had seen a sharp jump in consumption cycle. The ACs had grown by 4 or 5 times. The automobile also had grown by 4 or 5 times. This is where the consumer space can have a good time. You need to pick it as per the valuations also. So this is what I discussed about the air conditioners. You have a 6% market share. So SRF gave us very good returns. Asian Paints and Pidilite we have kept here. Now Asian Paints and Pidilite, if you see, whenever the crude prices move up, they go into some kind of consolidation. But again, you can see these periods. But again, they start moving up. The reason being, they are such a solid franchises that they increase the market share actually in any tough period. Again, Asian Paint has done it. There is a fear Grasim is going to come 1 year later. But when I speak with the dealers, within 3 hours, they can replenish the paint actually with the dealers. Which company is there in India within 3 hours, it can replenish pan India basis? And they are not only doing this, they are also venturing into every aspect of home improvement. They have acquired companies like White League. So they have acquired these soundproof doors also, that particular company. They were already there in the sleek kitchens. They are now in the bathroom fittings and all. So they have expanded over the period. By the time somebody reaches to a certain level, they would have expanded them actually by that time much more. So you need to have these companies in the portfolio. But as I said, weightages are very important. How you are aligning your weightages to the stocks in the portfolio, in what kind of scenario, market is volatile, you need to be more agile in understanding that is what creates the alpha. And we have been able to outperform through ACE equity, many peers in the market in the last 1 year. Our one of the best pick has been Mahindra. Mahindra, if you look at these prices, we picked actually here somewhere around 590 levels. We picked the stock last year because last year also the rainfall was good. We understood the strategy of Mahindra for SUVs. They were looking at gaining the market share, which they have done through XUV 500, 300, Thar, and now Scorpio. We have also seen that Mahindra has started coming into the electric vehicles through the three-wheeler segment. Triozor they launched, because after two-wheeler, I think it is three-wheeler which will pick up the pace in EVs. So that is what actually Mahindra has done. And the tractor segment, they have 41% market share already, and that is where actually I think the growth is coming for the stock. So from here you can see it has already crossed 1100 now. So we have gained substantial returns in Mahindra, and that is what we are looking to do in other stocks also, by picking at the right level. We also look at long-term technicals. This is where we have put this particular chart here. I think it is very important. These markets are going to be a little more volatile going forward. So this is where we need to understand that when to enter in a stock, and ultimately when we can reduce the weight in the stock going forward. I think that will decide the how you are outperforming the benchmark. I just come to the returns now. I think that is also very important. SRF, Mahindra, ICICI Bank, Bharti Airtel, that is how the gains we have got: 155%, 83%, 70%, 50% in these particular stocks. This is the performance in financial year 22, because financial year 22 we had two half. In the first half, market was fine, but in the second half, market had given up, and there was a substantial fall in the month of January. As I said, we were able to hold the gains in that period, and that is the reason of outperformance in financial year 22. Financial year 23, if you look at this month, again, when the market moved up, we have outperformed the market. So this portfolio is designed in such a way that it is able to absorb the fall, and also it is able to speed up when it is required along with the market. Finally, these are the parameters on which you define a portfolio construct. The earnings growth for the next 1 year of ACE equity is expected to be 29%, vis-a-vis Nifty 18%. The standard deviation is little lower than Nifty despite the higher earnings growth expected. ROE is around 22%, vis-a-vis 15% of Nifty, and 60% of the companies here are zero debt. Some companies, 30% of the companies have debt, but it is debt to equity is less than 1. And obviously we have taken some metal companies also. This is where some debt component you will find. Like Tatacom also I mentioned, some debt component you will find. But overall, the balance of debt to equity is very much there in the portfolio. So that is all about ACE equity description. And now I think we should leave it for any question from from our investor side. Thank you.
Thanks, Amit. That was quite informative and elaborate. Thanks for informing everybody. So, guys, if you have any questions, you can write in the chat box and we can take those questions and convey to Amit. So, Amit, the first question is from one of the readers who wants to know your view on cross currency. So, they are saying the dollar has risen against most of currencies, but Indian currency it has risen only 5-6%, where globally it is 10 to 15% changes. So, what is your view there?
You're right. So this is where I said ki if you look at euro, it has fallen significantly. It used to be 1.25 and now it is at parity to dollar. In fact, it went to discount also. Now it is happening because the underlying current in Europe is little weaker. Russia also is playing around Europe, because recently we saw the announcement that they are going for some maintenance and the supply of gas will not come. So these kind of hiccups are coming. We need to see how their approach is going forward towards the Russia supply, because the statements also have been very volatile. Sometimes they say we will keep on taking the gas supply from Russia, and because the Russia banks are out of SWIFT, so they also say that they will do the deals in rubles. But then the statement comes that after 6 months or 1 year, they will stop taking gas from the Russia. So I think some kind of sanctity has to come from the statements perspective. And obviously, when this war will stop, it is much better for Europe than any other nation, because it is more dependent on the Russian supply. So that is what actually we need to see. Interest rates, they have already started increasing, but I don't think because they have delayed in increasing the interest rates, obviously they are looking at their underlying strength, and they will not be having that kind of pace of increasing the interest rate. So euro appreciation may be there somewhat, and that will create dollar in check, but because it has 60% weight in dollar index. But I don't see that kind of appreciation coming in euro actually right now. But if you look at yen, for example, in Japan, they also are giving 10 trillion actually of stimulus, and that is the reason that yen has depreciated to 1.35, and they have depreciated more than what rupee has depreciated against dollar. So who has a problem in such a scenario? The problem goes with the companies who are dealing, who have a base in those countries where the rupee is appreciating more than those. So I think IT companies are facing more 2.5%. As I said, cross currency loss is there. So going forward, my sense is euro and yen will remain a little bit weaker only. Pound we have to see with the government change. Because new government is going to come, what action they take now, that will decide some kind of pound move, because pound also has depreciated more against dollar vis-a-vis what rupee has done against dollar. So this is something we need to see going forward. But yes, these are the macro things which are has to be seen. Only then we can take any final, we can see the recovery there actually.
Sure. Thanks, Amit. The next question is from Mr. Anand. What he wants to know is, there is obviously a discussion about IT companies and everybody tracks big companies like TCS, Infosys. He wants to know what's your view on mid-cap IT companies where there's the due correction which has happened already.
Okay, so see, the major problem to IT companies came because of the interest rate increase happening, because the valuations had gone up actually to the roof. If you look at TCS, Infosys, the large cap IT companies, their valuations had gone to 29 times, or in fact a little higher. And the mid cap IT companies, their valuations were almost 41 or 42. Now, if you see after this correction, the large caps, they are somewhere close to 21, 22. The base case for large caps used to be around 18, 19. So they are 10, 14% higher than that base case still. The mid caps are 31. So mid caps are still very costly, relatively costly. So I would say it is better to stay away most of the mid cap. So selectively you need to buy mid cap IT, but large cap is looking better. I give you another instance. For example, TCS EPS 6 months before for financial year 23 was expected to be 124, and that time rupee was around 74. Now rupee has depreciated by 8% to 79.5, and the EPS projection is around 117. So 6% fall in the EPS and 8% depreciation in currency. That means almost 14-15% EPS downgrade the market was expecting already from the IT heavyweights. And if the Gartner report which came out about 6 to 8% of IT spending will come down, so far though, as per the orders, we have not seen that kind of decline. So $8 billion of TCS order we saw actually. So I think everything is on pace. This is the fear which has brought down them along with the interest rate hike. So this is where I am saying previously they were growing with 19-20% year on year, and now they are growing with 13-15%. So TCS has come out with 16% of year on growth. I think that is good. 3.5% quarter on quarter. So the numbers were relatively fine. The problem is with the margins, and that is happening because of more attrition. So attrition in some companies like TCS, it is close to 20%. In Infosys, it is close to 26%. So they have brought down the margins by close to 1 to 1.5%. So that is one feature because of which the overall EPS has been was downgraded last by the market. And I think this is where we should start taking call on the large caps now, at least, that most of the things are coming in the price. And even if they come to 20, 21 valuations, I think it becomes very lucrative now.
Sure. Thanks, Amit. There's an interesting question from Mr. Venkatrakrishnan Natarajan. Now, he wants to know what is so unique about your ACE PMS. How do you basically, what's the edge or what's the differentiation it has with the other PMSs available in the market? So, what is the USP here?
So, sir, I give you two examples. I cannot directly compare, with the other PMS houses, but I can quote some examples. Some PMS houses, they say that you only need to look at the consistent growth companies, but the problem is you are not in a low interest rate scenario. Where the interest rates are moving higher, there will be tapering off of the higher PE levels, and that is where seeing a growth in the portfolio will be, it will not be a regular phenomena. So you will face problems. That is where you need to start bringing in those kind of stocks in the portfolio which are value, but which are giving growth now because the tailwind of earnings is coming with them, and they are the market leaders. And that is where ACE is different. We believe in a story of averaging out the PE of the portfolio. We believe in the story that in India, there are sectors where the new money is going to come. And these are the domestic cyclicals because the government is equally agile and they are coming out with the reforms every now and then. So rather than looking only at the global footprint, which may go into some recession because the yield curves are also inverted, still US yield curves are inverted, but I think the domestic companies which are coming out with a new tailwind of EPS growth, they are going to create money for you now. That is one thought. Second is some people say that it is always better to look for skin in the game. So what is skin in the game? So they talk about 25 to 30% of at least promoters stake in the company and only buy those companies. In that case, what is going to happen for your investment in ICICI Bank? What is going to happen for your investment in Infosys, which are completely 100% free float companies, and now where you are seeing a much higher growth. So this is what ACE is doing because we believe in a comprehensive approach. We believe in an approach to play as per the market, and that is where I think we have been able to garner good results for our investors.
Sure. Thanks, Amit. Amit, there's a follow-on question on your view on PSUs, especially with PSUs like LIC. What is the future there, according to you?
So I think because continuously in my thought process, I have been talking about look at the companies which are increasing market share. So when I talk about, the company that you mentioned, where market share for the new business actually has come down. So this is the reason it can, consolidate more. And my sense is when you talk about insurance business, I think look at the general insurance business because we had a deep discussion in our team also about insurance. Insurance has not been participating for the last 2-3 years now. So there was a discussion what to do. We had brought down our stake in the life insurance. In fact, we exited also from the life insurance company. But general insurance, I think, has a lot of tailwinds because 40% of the business comes from the motor insurance. Automobile was not doing good, but now automobile is bouncing back. We have seen the recovery. We have seen the rural segment recovery. We have seen two-wheelers, which is more than 70% of the overall automobiles in India. There the recovery has come in the recent period. So I think motor insurance will provide you a much better tailwind actually from the current valuations. Health insurance, the thinking has changed. We have already started seeing a lot of health, people taking the health premiums now. So, and it is an online, completely online space where actually the more and more people can take the benefits. So my sense is whether it is motor or health, because they comprise 60% of the business of the general insurance. And then the crop insurance comes where also the awareness has increased among the farmers, and with the crop prices relatively higher, more accrues happening, I think the crop insurance also will come into picture. So this is where we are playing more. We are looking at the general insurance more right now at the current juncture.
Okay, thanks, Amit. There's more of an observation from Mr. Sandesh. What it says is whenever some sector works positively and grow, government introduce some new taxes, and so basically he's saying most of companies are chasing this one. So if your hypothesis goes different because of government scenario, how swiftly you will change the perspective and how swiftly you will change the portfolio?
So I think what I have understood from you that this is a question that if suppose the taxes are levied in any particular sector, then what will you do? So for example, take the case of ITC. In ITC, you have almost 63-64% of tax. Now, what are you expecting here, or any other sector? So yes, when the GST or some other thing increases, obviously it impacts the whole sector. It impacts every company in that particular sector, and that is where first of all, if you are there with the market leader, you will be able to absorb that pressure more because interest rate increase is one thing. Second is the fundamental growth. So if there is a lot of juice in the sector, right, a lot of demand in the sector that is driving the fundamentals, I don't think there is any point of just exiting from the sector on the basis of interest rate increase of 5% or 10%. There may be a short-term trouble, but it is happening across the companies. So if you are able to absorb it through the market leaders, I think you can gain further rather than moving from one sector to another sector. What is the guarantee tomorrow in the sector in which you are moving, the interest rates will not be increased? So rather looking at that particular feature, I think you should look at the underlying growth of the sector and the demand perspective and the overall pie that you are looking at from the growth perspective.
Sure. Thanks, Amit. Amit, since you are also handling the Hong Kong desk, there's a question from Mr. Pintu Roy, which is more on global portion. So what he wants to know is what's your view about global economic recession? Is it coming in a big way or is it only a myth? As we are always thinking in long term. And on that scenario, how would India get impacted?
Yeah, so see, recessionary scenario to a certain period it can come. So there is no doubt it is possible. We cannot always say no, recession will not come. It can come to some extent. But what is recession? Recession basically the slowdown in the economy, right? So that is if you are increasing the interest rates, that time only you are aware of that you are slowing down the economy because you want to decrease the inflation. A very high inflation is also not good because that impacts the demand from the consumers. So if you can bring down the demand, if you can bring down the inflation, start increasing the and in between face the slowdown in the economy, it is better because then the demand scenario eventually will emerge from the consumers, which is good for across the sectors. I think this is what the US government, which is a developed market, they are doing after understanding something because they were behind the curve. Initially, they were talking about it is more because of supply constraints. When the supply constraints will be removed, everything will be sorted out. But they were not aware that tomorrow Russia-Ukraine war will come up. They were not aware the Omicron will again go to China and they will have the shutdowns in Guangdong, which is their commercial kind of business place, and even Shanghai. So these things were not there. So they actually remained behind the curve and inflation moved up further. It moved up very substantially. So they started increasing very fast. They started doing the front loading of interest rates. 75 bips is not a joke. In a single meeting, they increased by 75 bips. Now they are talking about 1%. So that created a lot of volatility in our markets, emerging markets also, because flows are coming from outside. So that is something that creates problem for us also. We are not totally different. But going ahead, if suppose inflation starts coming down, our inflation is already in control almost because of monsoon also if it comes to 6%. If you look at RBI, their focus is to keep it within 2 to 6% because 4% plus minus 2% they are talking about. So if we come to 6 or below 6, I think it's a good situation for RBI for then they will start reducing the interest rates also. I mean, not reducing, but at least they will not increase the interest rates thereafter. So these are the things which are little unprecedented. Mortgage rates in US have moved up already very fast. Just few months back it was 2.9, now it is 5.7%, and that is the reason the people's EMI in mortgage in US has got almost doubled kind of thing. 70% jump we have seen there in the, and that is where if they can bring down the inflation fast, I think that is good for that economy, though facing some kind of recession. So I think India is already facing it. It is not like we are not facing it. Our bond yields have already moved up much faster because US bond yields have also moved up much faster in anticipation of what is going to happen. What Bharat said in the beginning, markets always look forward. So I think that is a time where we are into. We should start looking forward. Recessionary scenario is already coming in the price that we need to understand.
Sure. Thanks, Amit. Thamik, there is one more question which is more on commodity cycle. So given the state of cycle, where do you see steel is heading towards?
Very important because my sense is there are two buckets for commodities. One bucket is of industrial metals, the other bucket is of fossil fuel. Industrial metals, my sense is that demand can again come back eventually because we were totally underinvested in this segment. And again, because economies, they will try to create jobs, they will spend more for infrastructure because job creation is not always for skilled labor, it is also for the unskilled labor. So in that case, spending money on infrastructure always helps that particular segment. And that is where the demand for aluminum, steel will again come back. And there is no alternative to that. There are alternatives to fossil fuel. We are already working on ethanol. Brazil in the cars are already moving at a very high ethanol blending. So the countries are looking for alternatives to fossil fuel. We are already looking solar. Our government has already recently announced that whatever the power generation of 390 gigawatt is there in India, 40% actually is already covered now with the renewable energy. So we are also moving fast. We are moving into hydrogen now. So alternatives are being created for fossil fuel. That is what we need to understand. So I think the demand for metals can come back. Recently, the problem that we are facing is the slowdown in the real estate market in China, which is also their own driven. They tightened the screws, and now the slowdown is there. The total demand of commodities comes 30% comes from the real estate in China. And if you see the total steel production in the world is 1.8 billion tons. And out of 1.8 billion tons, 1 billion ton comes from China. And out of this, if you see right now, the export from China recently has increased because the total the consumption in the own economy of China has reduced because of the slowdown in the real estate. So that is the reason some part of export has increased. So out of 1 billion ton, they export around 84 to 90 million tons. So close to 1 billion ton they export, which is slightly increased, and that is also keeping the prices lower. So in the near term, the prices can remain lower, but eventually my sense is industrial metals should bounce back.
Okay, thanks, Amit. Next question is from Mr. Pradeep. What he wants to know is, according to you, is the worst over for India in terms of market movement down? Or in next 2 quarters, what are the trigger points which you will watch for, which could take markets either too low or too high?
So I think FIIs, they have been selling not only from February onwards when the Russia-Ukraine war started, they have been selling from April 2021 onwards, and more than 3 lakh crores they have already sold. But we need to understand that what happened before that period. So from October 2019 till March 2021, we had seen more than 2 lakh crores of inflows by FIIs. And that was the period when Nifty had given a move from 12,000 to 15,000. Now, 12,000 was such an important level for Nifty because last 4 or 5 years, Nifty was not able to sustain 12,000. It was just moving from 10 to 12 or 11 to 12,000. It spent time. There was a global slowdown also we saw in that particular period. But then towards the end of 2019, in October 2019, we saw the massive cuts in the taxes, or the new manufacturing came to around 15% tax. So that is what created the trigger. And we thought that this market will create new highs, but then COVID came and that could not happen on immediate basis. But now when these flows came in those 6 months of period from 2020 ending till 2021 first half, we saw that Nifty finally took out 12,000 and moved to 15,000. And when it reached to 15,000, the FI outflow started. So why FI outflow started in that period? I think there was an expectation that there is a lot of liquidity which is already there in the markets. US balance sheet had gone to 8.5 trillion from $2 trillion. So it expanded like anything. A lot of money was given into the hands of the people. So inflation, there were green shoots of inflation moving up that time. So I think the bigger hands, the FIIs, they started taking the call because valuations also were steep. It is trying to start taking out money. So that happened from April onwards when Nifty reached to 15,000 levels. That is the reason I think 15,000, that is one important level which we have been continuously talking about with our investors for investment. So Nifty came closer and then recovered also. And in fact, last 1.5 years, the Nifty broad range has been 15,000 to 18,000 only. So I think this is what can happen. Time correction can happen, but eventually you need to understand price to earning is contracting. Markets, if see decline, your investment should go. Stocks are still relatively cheap, even though Nifty has recovered. So I think investment for long term definitely demands now. And coming one quarter or 2 quarters, so I think looking at the domestic shape up, it looks bright. But if anything negative comes from the Russia-Ukraine, which we don't have an answer right now, obviously it will impact. But when we are investing for long term, I think the declines in the market should be utilized. This is all I have understood over the period.
Sure. Thanks, Amit. Kishore, you may have some questions on your chat box as well.
Yeah, I have a question, but I think before that, there was a question from Mr. Venkat Krishnan about how ICE is different from others, and I think Amit addressed that from the portfolio perspective. I think it's also important to understand that in Amit, we have a fund manager who is also an expert on the technical side. And I think very few fund managers have both the fundamental as well as technical expertise, and is highly decorated for his technical expertise. That is one difference. And I think the other crucial difference is I think we are probably the only PMS where in investment committee we discuss ideas and strategies. We also call external fund managers. Right? And I don't think this is done anywhere else, right? So here you have, a way of functioning where you're saying, okay, we have our knowledge, we have our ideas and stuff like that. Let us also look at what other people are doing, right? Let us also get an insight into what their ideas are. So we actually invite, other fund managers who are managing other portfolios to come and talk to the investment committee and give their view also. I don't think this happens anywhere else. Right? And what you actually end up having at the end of the day in the portfolio is the best of the best picks. Right? So these are two things I also wanted to add on. Let's reply on that question. There is a question from Sandesh who says, what is your take on the aviation sector? It is becoming crowded, and we expect tourism to grow post-COVID. And you haven't touched this area yet in your commentary, hospitality, hotels, so on and so forth. So, what is your take on that sector?
So I think the overall, space which is on the unlocking theme, that is no doubt reviving. There is lot of discretionary expenditure which was hidden, which is coming out now. We are seeing people are moving out. They are spending for hotels outside. They are going for travel. That is where the airline industries also are going to see good growth going forward. The only thing is the ticket prices have also increased because the crude prices were higher, and 50-60% of the cost of ATF of airline is directly coming from crude. So I think that is something is something one hurdle. This is what I feel going forward. So my bet will be more on, if you can look at certain hotels or in that particular segment, or you can look at some companies where the like people are going back to offices, and from that particular segment, if you can look at, I just give you one example. Generally, people say that when there was more working from home, the cigarette consumption was quite low, because when you are at home, your cigarette consumption actually comes down. But when you start working and going to offices, we have seen there is again a jump in the cigarette volumes. And that is again one of the thing why ITC has started performing actually recently. Now there is always a fear that after 1 year, because after every 2-3 years the government increases the tax on the stock, and but if it happens after 1 year, so within 1 year you can see some kind of appreciation in that particular stock actually also. So hotels, when I look at, I think Indian Hotel is one. They have luxury segment. They have Ginger also. If you look at Ginger as a hotel chain, in Santa Cruz, they are going to change the image of Ginger hotel chain, because the kind of structure they are going to create for Ginger there in Mumbai, I think this is going to be significant. So Indian hotel strategy is looks very good. They are already debt free. They raised the equity. They diluted something. They raised the money through equity, and then they have gone totally debt free. So I think this company looks better to me going forward, and because hotels in the luxury segment also are going to perform, because the corporate people, they are already moving into now into the luxury segments. The rich are already moving outside, because they have been there for 2 years at home, so they are moving out, they are looking for luxury properties. So I think that segment is going to pick up. This is what I believe.
Thanks, Amit. I think that's it with regard to questions, at least in my box. Back to you, Manish.
Thanks, Amit. Thanks, Kishore. Bharat, any closing remarks from your side?
Yeah. Thanks, Manish. Thanks, Amit, and everyone for being on this call. And I'm sure he covered everything, right from macro setup to individual companies, the entire strategy he follows in terms of building this entire ACE equity portfolio and the way he rejigs this portfolio, on a regular basis. So I'm sure it was an insightful session for all of us to understand what really going behind the scene, what really they are thinking, and how they are really trying to create what we call a risk-adjusted return, which is superior, and provide a better solution for your long-term investments. So thanks a lot again to everyone on the call, and thank you everyone for joining the call. Thanks a lot.
Thank you. Thanks.
Thank you. Thank you, everybody. Have a wonderful weekend ahead.